So we're live right now, Craig.
Awesome.
What's going on, everybody? Brad here, Acre Mortgage, obviously. I made a post a couple days ago that we're going to start doing these live events every Wednesday at 12:30. We're a little bit late, just getting things rolling. And we're just going to talk about different tips, ways, things that are needed to know when financing a home, whether it's refinancing or purchasing. I want to introduce my business partner. For those of you that don't know Craig, Craig and I have worked together my entire career, so about 12 years. I actually worked under Craig at one point at our corporate office. He was the branch manager, and then Craig and I decided to open our own office, and that was back in 2016. And we've made a lot of changes since then. Craig, why don't you introduce yourself really quick, and maybe you could talk about some of the changes, like the difference, the things that we're doing in terms of our roles with the company.
How's it going, everybody? I've been doing loans since about 2004, so the better part of a little over 17 years. We decided in 2016 to open up our own branch. We've made plenty of changes, as Brad might agree, and I do more of the product role in a sense, and qualify and do consultations with clients. So I'm more of hands-on in the loan process itself, whereas Brad is more of a business development role, reaching out to our referral partners, trying to help with marketing ideas, help consumer relationships. So it's a good thing that we're doing this. I feel like we've kind of settled in our roles as branch managers, and we're really excited to get on this live presentation because we're interested in helping and educating people.
Awesome. So today, I guess the goal here is that you're constantly, you're like the mortgage expert in a way. You're constantly reviewing, reading guidelines. I've probably forgotten more than most people know, just because they're constantly changing, right? So you're always up to date. There's a lot of times where I'm coming to you, asking you questions just because I'm not as familiar or as up to date as you are. So I guess the goal here is that on a weekly basis, you're consulting with clients, you're coming across things, issues, concerns, you're educating those people. And our goal here is to kind of share those tips with the general public, because a lot of them are valid points. There's a lot of good information that we're sharing with those people, so we might as well share with other people. Today's agenda, I guess, is more, what's up, Kristen? Today's agenda is more focused towards down payment, right? Because we have a lot of people. I just spoke to a lady yesterday who was under the impression she had to make a 20% down payment. And when people say that to me, it's very specific. So my mind doesn't think you're putting 20% down because you want to finance less so you could essentially save money. My mind goes to, you're putting 20% down because you want to avoid mortgage insurance. What's your thoughts on that?
I think it's very specific to the person's scenario. A lot of times, if you think that you need to put 20% down, if it's just to avoid mortgage insurance, it's one thing, but maybe saving that money in your pocket is more beneficial to you than the increase or slight increase of a monthly payment. So it's a lot of times that extra cash goes a long way when you're talking about buying a house, whether you got to add extra paint or, do some minor renovations after the house closes, because no matter what, there's going to be upkeep with buying a house after you close on a loan. So having some additional funds in your pocket after you settle is important. Nobody wants to be cleaning out their bank account, so to speak, after they buy a house.
Agreed. So let's talk about mortgage options where a 20% down payment is not needed.
So I feel like to kind of, and some people might be more advanced than others as far as knowledge of what you need for down payment, but this is some basic information for somebody that doesn't know a lot about loans in general. There's 4 major loan types that are traditionally offered to the public from most banks across the country. You have your 2 most common loan types, which are conventional and FHA. And then you also have a VA loan, which is specific to veterans. And you have a USDA loan. and all have options for high percentage financing and low down payment requirements. So the misconception is that you need 20% to put down, and technically you don't need 20% to put down. So let's go through each loan type and kind of talk about the down payment requirement or minimum down payment requirement for each loan. So for a conventional loan, you can put as little as 3% down of whatever the purchase price is. For an FHA loan, the minimum down payment is 3.5% of whatever the purchase price is. For a VA loan, you don't have to put a down payment. So you can get 100% financing for whatever the purchase price is. And USDA, very similar. You don't have to put any down payment. So it's 100% financing. So all are really good loan option types. And, we'll probably get into more details about the loan specifically later, and why, one loan, why you would pick one loan over the other. But in general terms, they all have options where you have minimal down payment.
So the USDA, I mean, and I know what it is, right? But I'm thinking in terms of somebody that might be watching this video, like when I think USDA, I'm thinking hamburger meat or whatever at the grocery store, right? Like I see those stamps on the packaging all the time. What is that? Can you explain what a USDA loan is? Because
yes,
it's a great program, but
they're both. I mentioned the two loan types first because there aren't, with conventional FHA financing, there aren't real specific eligibility requirements, whereas VA and USDA, they have specific eligibility requirements. So we'll just start with VA first. For a VA loan, you have to have a certificate of eligibility. So at some point in time, you might have served time in the military or armed forces, or you served time in the reserves. But unless you have that certificate of eligibility, you would not qualify for a VA loan. So that wouldn't apply to everybody. And the same thing goes for USDA. So USDA is their specific eligibility requirements pertain to the property itself. That's the most important, is that you have to be able to purchase in a USDA eligible area. So these are your more rural parts of the country that is less populated than, the only way I could describe it would be to give you an example of areas common to where we're from. In South Jersey, if you're looking in Camden County and you're talking about Cherry Hill, or you're talking about Sicklerville, Gloucester Township, these are well-populated areas. Places in Burlington County that are less populated areas, like Chemung, like Metford, maybe in Franklinville and Gloucester County. These are less populated areas, so you're more frequently going to find properties that are eligible for USDA financing in those areas. The good thing is it's pretty easy to determine whether a property is eligible for a USDA loan. As far as the address is concerned, you can Google USDA property eligibility and type in an address, and it'll show you whether that property is located in an area that's acceptable to USDA. The other requirement is based on income for the household. So there's restrictions as far as qualifications for income. So your household income can't exceed a certain income restriction, is what they call it. So with those two loan types, you have those types of restrictions and different eligibility requirements. But as long as you meet those requirements, those loans are available to you.
The one thing, and I'll add to that, because all loans, just so you guys understand, closing costs are required, and they're pretty general. You have your lender fees, you have your title fees, and you have the cost of setting up your escrow account. And it changes depending on, obviously taxes, sales price, where you're looking. New Jersey versus PA, closing costs can change drastically, right? So they're required, and we can go over your situation if you're ever looking to buy or refinance a house with all the costs involved. Today, we're just talking about down payments. But the one thing I'll point out about the USDA loan, where it's different from every other loan, aside from the fact that it does 100% financing, is that the USDA actually allows you to finance closing costs into the loan. Now, a lot of loans you can finance it through getting a seller concession, but now that has to be negotiated with the seller. Typically, it's going to make you look, you're not going to look as good to the seller, right? So with the USDA loan, let's say the sales price was $100,000 and you signed a contract agreeing to buy the house for $100,000, and we found that the closing costs were $6,000. Then the sales price can be $100,000. We would write a loan for $106,000, and as long as the house appraises for the $106,000, then we can actually finance your closing costs into the loan. So this is the one program where you could almost bring absolutely nothing to close without asking for a seller concession. So
yeah,
I just want to point that out.
The biggest caveat with that is the house has to appraise. So,
of course,
and if you are under contract for $100,000 and the house appraises for $100,000, then you would not be able to finance any additional cost in the loan except for the price of the house.
Correct. And it's tough in this market because most houses are selling overvalue. Right. So, but we would, we like our approach is making a clear mortgage plan. Right. So obviously we're going to talk about those options, but we're also going to have backup options because we wouldn't want somebody going under contract with the expectations that they're going to get all of their closing costs covered. So either way, we're not here to talk about closing costs today, so we can move on. So just to kind of sum it up, VA loans are 100% financing, no down payment required, and these are for military, current or prior. They would have to have their certificate of eligibility, as you mentioned. The USDA loan is property specific, so we would have to look at the location. The USDA, like you said, does have a really fancy search tool. However, we can do this for you. So that's what we're here. We're here to help and guide you guys. So if you have questions, if you have a property in mind, we can certainly look it up for you. And then the other thing is the income. So there's income restrictions. Now, Craig, is the income based on the borrower or the entire family? Can you explain that? How does that work?
It's based off of household income. So if just because one borrower is borrowing the money, and let's say another person, a spouse, is not on the loan, you still have to count that income as in that median income restriction, so to speak. But there's other things that would lower the amount of that income that USDA determines in that calculation, and that's, I think, childcare expenses. So there's some different things that you can kind of lower that amount of income, but the income is pretty reasonable. I mean, we're helping clients, that are looking at $300,000 houses in some cases. So the best thing to do is either consult with us, obviously, or you can look up, just like the property eligibility, you can look up online the income restriction for that area. If your household makes above that, then it probably wouldn't be a loan that would work for you. But it's easy information to find out just by doing a quick internet search.
That's awesome. Or emailing my loan team at acremortgage.com or sending either one of us a private message here on Facebook. All right, so moving on, we covered VA, we covered USDA. Let's go back to the basics now, your FHA and your conventional financing. FHA, as you said, is 3.5% down. Is there ever a time where you need to make more of a down payment on an FHA loan? Other than when the house doesn't appraise.
I mean, I don't know if it's more, but there's certain situations where putting down more money for an FHA loan is more beneficial to somebody. And a lot of people don't know this. If you put down 10% on an FHA loan, well, let's go back. If you put down the minimum down payment, right, 3.5%, or anything less than 10% on an FHA loan, FHA requires that you pay mortgage insurance for the life of the loan. So as long as you're in that loan, right, you don't refinance, you don't sell, you're going to pay mortgage insurance, right? And those of you that don't know what mortgage insurance is, it protects the bank in case there's a default. And most loans have some type of cost associated with protecting the bank because of a default. But a lot of people don't know that if you put 10% down on an FHA loan, that your mortgage insurance will automatically terminate after 11 years. So that's a good thing to know, because even though, you might not qualify for a conventional loan, or it might not be the best program for you, if you have the funds available, putting down 10%, eventually that insurance would be removed, unlike not putting down 10% or borrowing more than 90% for an FHA loan. It's for the life of the loan.
It's 11 years, you said, right?
Yeah, correct.
So that's awesome, because instead of paying mortgage insurance for 30 years, like, because right now, right, like if you get a house and you use the FHA and this is your forever home, chances are you're not refinancing unless you're doing so to take cash out, right? So who would want to refinance, 3 years from now, to get rid of mortgage insurance, when essentially mortgage insurance is just a part of interest, right? So they're going to refinance to get rid of mortgage insurance and more than likely have a higher rate. So this is a great thing to know, because in 11 years, they can continue having that great rate that we're offering today, but the mortgage insurance goes away. So that's
and maybe you don't qualify for a conventional loan because of certain situation. Maybe your credit score, maybe it's not running through an automated underwriting system. For whatever reason, it shouldn't discourage you from trying to buy a house. There is a way to, eventually get rid of that mortgage insurance, and that's by putting down a 10% down payment for an FHA loan. Just getting the conventional, and we talked about the misconception a little bit. For home buyers, they think they need to put down 20%, and the main theme behind the mortgage insurance, theme behind putting down 20% is they want to avoid paying the mortgage insurance. What a lot of people don't know is that conventional loans, you can pay mortgage insurance differently, and it's based off of how much you put down in increments of a percentage of the purchase price, right? So in general, if you put 5% down on a conventional loan, it's a certain percentage of coverage, right? If you put down 10% of the purchase price, it's a lower percentage of coverage. If you put down 15%, it's an even lower percentage of coverage that's required, which reduces the amount of what you're going to pay in insurance. The other part to that, is if I put more money down, that lowers my amount of mortgage insurance, but also you can pay the insurance differently than other types of loans. Like, for example, an FHA, they charge an upfront fee at settlement, which can be financed, and they also charge an annual fee, which is a part of your monthly payment. But with a conventional loan, you can pay your monthly fee. There is no upfront fee. You can pay what we call a single paid option, right? Which is you're paying the insurance for the life of the loan, or you could pay a split option, which is similar to how FHA works. You pay a smaller percentage upfront, some upfront, and then some annually, which is charged monthly, right? So there's different ways that you can pay this insurance that might be more beneficial for your situation. But with regards to mortgage insurance, there's a lot of things that contribute, or I should say, that change the cost of that insurance. So there's a lot of factors involved with determining the cost of insurance. And that might be the amount that you put down, the credit score, how many people are going on the loan, are you self-employed, are you a first-time home buyer, the property type. So all those factors contribute to that insurance, whereas these other loan types, USDA, FHA, they do not have those factors. They're set almost. They're all the contributing factors for conventional don't apply to those other types of loans. So regardless of your credit score, if you're putting down 3.5%, you're going to pay the same mortgage insurance as somebody that had a 750 credit score, right? Where for a conventional loan, it's different. All those factors apply in determining the insurance cost.
So, yeah, I mean, I think the single paid mortgage insurance is awesome regardless. It's definitely an option if you're trying to avoid it with the conventional loan. Most of your government loans are obviously going to have it. So I think it really comes down to, what your situation is, obviously. We do have some questions, Craig. So I didn't know if you wanted to elaborate any more on that. I do want to go into 100% financing because now that we've kind of covered the different down payments, I do know you said that 3% down is available on a conventional loan. And I know personally there's 2 instances when 3% is allowed. Can you briefly explain that for people that don't know?
Well, I feel like, and tell me if I'm wrong, you can do a 3% down standard conventional loan if you're a first-time home buyer, right?
Correct.
And then there's another option, which is a relatively good option with conventional financing. They're not necessarily for first-time home buyers, but they give discounts on mortgage insurance mainly. Okay. And sometimes those loans are priced out better, and they're called Home Ready and Home Possible. Home Ready is associated with Fannie Mae conventional financing. Home Possible is associated with Freddie Mac conventional financing, but all have different perks. And in some cases, you can get a lower interest rate with that program than maybe a standard conventional 97%. The mortgage insurance coverage is lower, so the cost of mortgage insurance is lower. And the only, there's 2 basic requirements. One is they also have a median income restriction. I believe, and I'm not 100%, this is something also you could look up online or contact my loan team and we'll do the research for you, is I feel like it's about 73,000 income restriction. So you can't be making above that. But the other part also is that you have to take a counseling course, which is something that's done online and easy to do. But those are really strong programs. We've done a lot of those Home Ready, Home Possible loans. And then you have your standard 3% down loan, which is going to have higher mortgage insurance coverage, obviously, and typically a little bit higher rates than 5% down or 3% down conventional options.
Yeah, so what they did was, my understanding is that Home Ready and Home Possible came about because it was a conventional loan that would compete with FHA. So they're trying to make it more affordable, so there's less loan level pricing adjustments. Therefore, the rates are a little bit lower. And then the mortgage insurance coverage, usually when putting 3% down, they require a 35% coverage, where with the Home Ready and Home Possible, it's only a 25% coverage. So because the coverage requirement is lower, the mortgage insurance rate is going to be lower. So they're great options. So yeah, I just wanted to address that really quick because I think outside of 100% financing, the Fannie Mae, the 97 for first-time home buyers, and then your home style and home, or I'm sorry, your Home Ready and Home Path loans are going to get you the most amount of financing.
Home Possible.
Sorry. You're the mortgage expert, man. I got it here. I did my job. So either way, those, like when you're talking about down payments, that's where you're going to get the most financing with the Home Ready, the Home Possible, or your conventional 97, 3% down. You can get 100% financing using the USDA. It's a great program, and USDA has a reduced mortgage insurance. It's a lot less than what you're going to pay on an FHA loan or a conventional loan in terms of the monthly. So USDA is a great way to get 100% financing. VA all day long. It's probably the best program because there's no monthly mortgage insurance. They're great rates. We're taking care of everybody, but everybody needs to be taking care of your veterans, right? So that's a great program to get 100% financing. What happens, and I'm just kind of giving you these questions as if I was a consumer. I kind of know some of these answers, but what happens when you have a person that you're working with that doesn't qualify for the USDA loan because they're looking in, say, an area like Cherry Hill, and they're not a veteran? Is there ways for them to get 100% financing or help with the down payment?
Yeah, we work with, and most state agencies or most states offer some type of first-time home buyer mortgage financing option. In the state of New Jersey, it's NJHMFA, and they offer down payment assistance towards government loans, right? An FHA loan is the most common loan used. And it's a very good option. They allow you up to $10,000 towards down payment and or settlement fees. So it's a really good option. And we've done plenty of those, and there's definitely restrictions regarding NJHMFA. And I don't know if you want to go over those restrictions now or talk about it some other time.
I mean, I think the reality is that, so you're saying that they can get $10,000 that can be applied towards down payment or closing costs. So let's say, for instance, a borrower is buying a $200,000 home using the FHA. Your minimum down payment in that case is going to be $7,000, right? Correct. So if you're getting $10,000 through the state, now that $10,000 is covering that $7,000 and then giving you an additional $3,000 to put towards closing costs. There are pros and there are cons that in some cases outweigh the pros, but the goal here is that we want to create a referable experience. We want to give you a clear mortgage plan. So if you're trying to figure out what's best for you, we're going to help you through that, right? So Craig, you do something, not to go off topic here, but every time you do a consultation, you provide clients for the most part with a total cost analysis. Can you just explain that briefly what that is?
So it's a comparison report that shows you different options that you may qualify for. So you might qualify for a couple of different of these loan programs, or you might want to see the difference between one program or another so you can visualize what we go over in a consultation over the phone. So it's important to understand, okay, I do qualify for a conventional loan, but I also want to see how my mortgage would be or what my criteria would be for an FHA loan. Or maybe I want to compare the New Jersey financing type of mortgage with the $10,000 in assistance to a standard FHA loan. So these reports that we create, we don't just say, hey, here's your mortgage option. This is what you qualify for. We have the ability to qualify you for multiple programs, and the report allows you to compare and see why we might suggest one program over another. It's a great report.
Yeah, I like it because I think the most important thing is that sometimes people are looking at it more from a granular level, right? Like we're not looking at it from all the way up here, right? And the total cost analysis, it's not only showing you your out of pocket and your monthly, but the biggest thing is that you're doing like a 5-year comparison, a 15-year comparison, so they can truly see what they might save going with this program that's going to require a down payment versus taking, a $10,000 grant from the state and using their type of financing, which I always tell people you can't get blood from a stone. So the reality is buying real estate is a great investment for anyone. It's either you can do it or you can't. And if what's keeping you from doing it is your ability to come up with a down payment, then the state financing it's an amazing program. It might not be the best for everybody, but it's something worth looking into. So for those of you that are watching this video, I guess what I'm getting at is there are alternative options. If you don't have money and you think that the reason that you're not buying a house or what's keeping you from buying a house is that, you don't have the money, we might have a program for you. And there's no cost for us to review your information and provide you with the total cost analysis. And at the very least, we can at least come up with a clear mortgage plan, right? So that you have something to work towards. Craig, I think we've pretty much covered mostly everything regarding down payments. There are a lot of other untraditional mortgage products that we could sit here and talk all day about, but we're really trying to just educate the general public. And for the most part, these are the programs being used. We do have a few things. Kristen, my wife, some of you may know her, she wanted to point out that the scrolling thing on the bottom of the screen says 2020. It is 2021. So you are watching this video in real time, just so you all know. Just wanted to let her know that I'm addressing that. And she also brought up a great question, nothing to do with down payment, but she wanted to know, she wanted us to let people know the difference between an appraisal and an inspection. So do you want to comment on that?
Well, yeah, I feel like a home inspection is going to go through the property you're buying with a fine-tooth comb and find every little thing wrong with that property. That's the general consensus, right? Whereas an appraisal, it determines certain property criteria that, or property integrity, I should say, where if there's something going on with the property, if there's something wrong with the property, that it meets the criteria for the certain loan that you're doing, right? So there's certain flexibilities with certain loan types with appraisals. Like, for example, a conventional loan. A conventional loan might be more flexible with property integrity guidelines than an FHA loan, where they have certain things that you might have to fix prior to you getting the loan, or the seller would have to fix prior to you getting the loan. That might be chipped paint for houses that are built before 1978 that have possible lead-based paint in the home, handrails going up and down steps or porches, cracks in the sidewalks. These are typically things that might, not to say all the time it'll happen, but might get overlooked in a conventional appraisal. Similar situations with most government loans, VA, USDA. But a home inspection is not something that we see. It's for you to make a decision as a borrower or a buyer of a home to make sure that you understand everything that's going wrong with the property. So an appraisal is required in order for you to get a loan. A home inspection is not. But I would never advise anybody to buy a house without knowing what's wrong with it first. So I feel like those are the things that are different between a home inspection. Is a lot more detail in the home inspection report, a lot more into everything that's going on with that property, anything that you need to know about plumbing, electrical work, major items that are wrong with the property. That's for your eyes, essentially. And then that's not required, but an appraisal is required for you to get a loan. So I feel like those are, they're both important, but it's not required for you to get financing.
Good. Perfect. I agree with everything you said too. So thanks for that question, Kristen. Not that you didn't know the answer, but Kristen, if for those of you that don't know, she's my wife, and she was a processor here with us for many years. She still is a part of the team. She's just not processing. So I think she would get that question a lot when processing loans, because she was kind of in charge for getting the appraisals ordered when she was processing loans. I think we'll wrap it up here today, Craig. Natalia has a question, though. She's asking, what is the name of the New Jersey state program that helps with assistance? Natalia, I'll answer that one for you. It's the New Jersey HMFA, Housing Mortgage Finance Agency, right? New Jersey HMFA.
Well, I feel like she might be talking about what's the specific program name at NJHMFA. And I feel like you have two, right? You have Home Seeker and you have Smart Start, but I feel like Home Seeker is going away. Smart Start, I feel like, has been the main program for NJHMFA. That's, if you look that up online, or you need help in understanding, do you qualify for that, we'll gladly help you out. But I believe the name of the program is Smart Start.
That's awesome. So yeah, so that, Natalia, if you have any questions at all, you can send me a DM right here on Facebook or LinkedIn, for that matter, since you're on LinkedIn. And we'll be more than happy to help you, or email us at myloanteam@acremortgage.com. Craig, I think that, we want to keep the, obviously keep these to drive time. Not that people are watching this in the car, but we pretty much been on here for a half hour. Is there any last points you want to bring up?
No, I think we covered a lot. And the good thing is we're doing this once a week. So, if what I can suggest to the audience is, if you have questions, email us, or you want to hear about topics in the future, we'll take these suggestions, and we'll continue to do more videos on what, the audience wants. So.
Yeah, I like that. So, and I don't have anything to add. So, guys, thanks for joining us. One last thing, Craig, what would somebody that's watching this do if they want to take the next step in buying a home? What like just email my loan team, or can they contact you directly? Is there a team member?
Yeah, I mean, you can contact me directly at 856-552-0715. I would start there. Email my loan team, and we can have one of our team members give you a call or contact. I don't know if we want we have a registration form. I don't know if we'll decide later whether we want to put that registration form, or maybe we'll create a new registration form for the audience. We'll figure it out. But I feel like if you reach out to my loan team at Acre Mortgage, somebody's going to reach back out to you. My direct office line is 856-552-0715.
Yeah, so either, like you said, my loan team, you can send us a direct message here on Facebook. We have a website. It's acreloans.com, A-C-R-E, loans, L-O-A-N-S, acreloans.com. You can get a lot of valuable information on the site, or you can contact Craig directly, or we have a team hotline. It's 866-416-7156. And that's about it. Guys, thanks a lot for joining us. Craig, thanks for being here and sharing all your knowledge.
Thanks, guys. Take care.